two different sets of data. Again, this is the tale of two markets. This is the hard data. This is the unemployment number. That's the how many houses are being built. That's how many cars are being purchased. Those are the numbers that we can quantify. This data is soft data. It's survey data. We're going to call you up and say, hey, have you thought about switching jobs? Are you looking for a job? So this is soft, and it's kind of indicative of what expectations might be, but it hasn't reflected in the hard data yet. And so at some point, again, these two things have to converge. Either the hard data has to catch up, or the expectation will have to change, right? Because no one's going to be excited without any result for 5 years. It's just that won't work, right? People don't respond that way. So those things have to come together. We just don't know which way they're going to come together. At the same time, it's not a bear. I'm staying bullish. Like, this is not a bear. That's a monkey. We don't have to worry about that. So this is what I mean when we talk about slow growth. Okay. So economies have been growing. GDP has been growing very, very slowly. And in that slow growth, that gives us a space for it to grow longer. However, companies already anticipate that, and that's what they're saying here. By a large majority, fund managers expect global growth and corporate profits to be strong over the next 12 months. But they also know such expectations are already fully reflected in share prices. So if we have an expectation that companies are going to be more and more profitable because their revenues are up and they're able to control their expenses, and the market already knows that, and we're seeing a high PE rate when we're buying, there's less value, right? We're paying a lot for the earnings we expect in the future. What has to happen for those stocks to go up, those companies to go up in value? A year from now, our expectations have to be even higher, right? Or the stock price isn't going to go up. So there's a point where we're borrowing from these future returns, and we don't know where that point is. But so we started, this is part of our portfolio analysis stuff, is we started actually saying, okay, the US is a little rich relative to emerging markets and relative to Europe and other places 4 years ago. And so we take a little bit off, and we put it in emerging markets, and this is our promise to you. We do this, we look for value. The problem is, when you look for value, sometimes you underperform, right? So 2013, 2014, 2015, the S&P killed it. If you were somebody like us who was disciplined and took some money out of the S&P and bought some smaller companies or bought international companies, that was a drag on performance.
Short-term drag.
Let me get there. I got it. I know how to do this. I'm building.
Life jacket.
See, and this is what happened this year, though. So that's year to date. This is emerging markets. So I stood up here beginning of last year and talked about why you should be in emerging markets. Emerging markets have been down for 10 years. Why would you invest in this? I said, well, and if you really think about this, who's investing in emerging markets now? Who's putting money in there after it's gone up 17%?
Retail.
Play with me. Okay, that's a good summary of it. Anyone else have a? It's people who make the decisions based on what just happened. So they see it go up 70%, they get excited. Oh, I want some of that 70%. Then they put money in. Guess who already owns it? We do. And when they put money in, what are they doing? They're driving the price of the thing we already own up. It's nice. It's nice to already be there. But to already be there, you have to own it when it's cheap. That's why we buy it. That's why we look for that value. Okay? How did I do? Did I resolve that conflict pretty well? All right, just checking. All right. And this is, emerging markets across the board. Obviously, Russia's having some pain. China's doing really, really well. This is the emerging market total where you just saw. So we saw this a little bit earlier. This is the stock market, PE ratio of the stock market. Just up, right? Here is, we almost got to 11, not quite, down here. And now we're, sitting at, what is this, 20-ish, 21-ish? Yeah, we're high. So what do you do about that? What do you make of that? It's the reason I'm so excited about the fact that revenues are higher. That's a harder number to fake. Yes, bottom line earnings are easier to fake by, you can take. It's accounting. Accounting gimmickry exists all over the place. You can take stuff that you haven't actually earned and pull it into today's earnings. You can reserve money instead of calling it earnings, so you can recognize that later as earnings. You can do that. But when revenues are rising, that's a hard number to fake. And so that we've been waiting and waiting and waiting and waiting in expectation of revenues rising, and now they're rising. So that's a positive. So I want you to remember a couple numbers here. This is going to be your memory test for the day. 29.82 right there. And that's today's valuation based on Shiller cyclically adjusted price to earning. It's the CAPE ratio, okay? You hear about this in the media, it's called the CAPE ratio. He takes 10 years of earnings and normalizes those with the stock price. So 29.82 is current. That looks really high. The mean median, let's call it 16.5, okay? That's a long-term average. So right now, 30, 16.5. We're going to talk about how that normalizes in just a minute. There is a very, very good argument to say that right now, as opposed to any other time in history, it would be okay to have higher valuations. What is that argument? Anyone have an idea? If you're not going to invest in stocks, what are you going to invest in?
Bonds,
Real estate? Maybe also kind of bubbly? Real estate's kind of bubbly?
well,
Gold's really volatile?
yeah, it depends.
Bonds aren't paying anything? And if
Oh, a tin can in the backyard.
guaranteed to lose money versus inflation, right? So that's the challenge, is you have to put your money somewhere. And what's more overvalued potentially than stocks? Bonds. And those are the two big asset places, asset markets. So you have to put your money somewhere, and bonds are potentially more overvalued than stocks. If bonds collapse, they're not going to hurt you like stocks are going to hurt you. So I'm not saying get out of bonds. That's not what this is. I'm just saying that the valuation metrics are such that stocks are actually valuable. So you might see more people tilt towards that, and that would drive this up higher. Still, we are going to see, at some point in the future, we are going to see this average again. So the big question is, how do we get there? How long does it take? What's it look like now? Okay, we have biases in our investment process. Over long, long periods of time, value outperforms, small companies outperform, and profitability outperforms. And that's, over a long market cycle, those things are going to outperform. In the last 10 years, value has underperformed by a wide margin. So is that a change in cycle? Is it an anomaly? Will it revert? Every time this has happened in the past, it's reverted. Is it going to start reverting today? I'm not trying to call that. Over a long period of time, value outperforms. Short period of time, other things can outperform. This is also true of small versus large. Large companies in the last decade have outperformed. Search for safety, big name marketing budgets. Amazon is huge. Why would we not invest in Amazon? Jeff Bezos is on the cover of Time magazine. So there's reasons that people, for safety and for a feeling of security, invest in big companies and don't invest in small companies. Eventually, small companies look more attractive because long-term they outperform, because they're cheaper per unit of earnings, because pick your because. Long-term, small companies outperform. Last 10 years, they haven't. I think that if I'm going to invest, the best possible time to invest in small companies and value companies would be a time after which they've underperformed, knowing that long-term they're going to outperform. Right? Do we actually know? Can I say no? I can't say no. Right? I can say long-term, research shows that those things outperform. I have a sense that nothing's changed, that that's probably going to continue to be the case. Last 10 years has not been the case. At the same time, we're very, very calm. The last seven of the 16 lowest scores in the VIX, which is a measurement of volatility, have been this year. So volatility is the zig and zag, and this VIX, when we trade VIX, people trade VIX all the time, and the lower it goes, the less volatility we're expecting. Markets are not volatile. And this shows up in price action as well. So in the last 12 months, we have not, did you know this? We have not seen a 5% decline. Right? That's that kind of market, right? So 92% of years, you get a 5% decline throughout the year. More than half of years, you get at least a 10% decline. In the last 13 months, we have not seen a 5% decline. We should expect anytime now, a 5% decline. And that would not change my feeling about markets one iota. That should be matter of course, 5% decline, no big deal, roll with it. In fact, 10% decline, 15% decline, kind of the same thing. Now, is it comfortable? No. Can you do anything about it or predict it or get out of the way? No. Right, so when you build portfolios based on a plan, you take the appropriate amount of risk and you hold on to that amount of risk until you don't hold on to it anymore, until you withdraw some money, down payment on a second home, until you retirement income, until you, whenever you're going to use that money, that's when you change this thing. Okay. So we're way too calm. We're not even recognizing the risk that's out there. And it's never the bus that we see that gets us. Because look, we got Brexit, we got the Middle East, we got this guy, we got this guy, we got stuff's happening all over the place. This, bombs in North Korea, maybe they can reach Alaska, who knows. So there's no shortage of this. This is happening all the time. And it's always front page, and it's always something to be afraid of. But has it ever not been that way? I don't remember a time when it wasn't that way. Is it more crazy now because of this and because of where we are and because of our feelings about it? I think it's more crazy now because of those things. So our emotions get riled up. Markets don't care about our emotions. Okay. They don't care. They don't know my name. The market does not know my name. I have to admit that. So this could be a good sign. This is a crappy statistic because there's only 4 events since 2006. So yes, the last couple times this has happened last couple times volatility index has been this low, have been positive 1, 3, and 10 months, but the data set's too small to actually care. But it's an interesting thing.